Hello and welcome to the Tax Roundup. We'll be covering all that's important to accountants and advisors across the month of June. Inside this month, we're going to explore the extension of COVID-19 minimum payment relief for Div 7A loans. We'll look at the legislation enabling self-managed super funds to increase to 6 members and why. We'll also take a look at the case of the accountant, the cash flow boost, and the integrity rules. But first up, we have Michael Carruthers, who's going to take you through the law companion ruling on temporary full expensing. Across to you, Michael.
One of the ways that the federal government has attempted to stimulate the economy and encourage businesses to go out and spend money is the introduction of the temporary full expensing rules. Now, those rules are currently in play at the moment. We saw in the recent federal budget that the government is planning to extend them for another 12 months, although that legislation hasn't been passed yet. But in the meantime, we now have some further guidance from the ATO on some of the practical aspects associated with applying those rules. So the ATO has released a draft ruling which deals specifically with the temporary full expensing rules and sets out guidance on a range of issues that might be encountered as people are trying to work their way through those provisions. Now, not attempting to cover all of the issues that are dealt with by the ATO in that ruling, but one of the points that is made in that ruling, I think is worth mentioning as part of this update. And that is that the ATO confirms what we were hoping in that assets that are excluded from the simplified depreciation rules for small business entities can potentially still qualify for the temporary full expensing rules. Probably the most common example of that, and we come across this quite often, is assets that are subject to a depreciating asset lease. So if an entity carries on a business under general principles and has aggregated annual turnover of less than $10 million, then typically that entity would be able to apply the simplified depreciation rules, which would include things like the instant asset write-off and pooling rules. And for the time being, also temporary full expensing rules, which apply to small business entities. Now, there are certain types of assets that are specifically excluded from the simplified depreciation rules, and that includes assets that are subject to a depreciating asset lease. So typically, if an entity owns an asset and provides the use of that asset to another party on an extended basis, that asset would not normally qualify for the simplified depreciation rules, which means that it wouldn't qualify for the temporary full expensing rules as they typically would apply to a small business entity. Now, where there has been a bit of uncertainty is, well, if those assets are excluded from the simplified depreciation rules, could they still qualify for something like temporary full expensing outside of the simplified depreciation rules? Now, our analysis was that it seemed that that could be possible, and this draft ruling from the ATO suggests that that is the case. The ATO says that just because an asset is excluded from simplified depreciation rules doesn't then automatically exclude it from temporary full expensing. So if an entity was genuinely carrying on a business and happened to acquire an asset that was used or subject to a depreciating asset lease, it could still qualify for temporary full expensing on the basis that we're looking at the rules that apply to assets that don't fall within simplified depreciation. Now, the key thing to remember here is that the taxpayer still needs to be carrying on a business under general principles to qualify for temporary full expensing, and we need to ensure that this is an asset that is going to be used in connection with business activities. So if an entity is not really carrying on a business, it might simply be holding some assets that are then dealt with on a passive basis, rented to other parties. It may be that that isn't enough to constitute a business and therefore wouldn't qualify for temporary full expensing. So we'll ultimately come back often to that question of fact as to whether this entity carries on a business or not. Now, bear in mind the ATO's view that it is easier for a company to show that it carries on a business, even if it is mainly earning income, which would be classified as, will generally be thought of as passive in nature. But when we're dealing with entities such as trusts or maybe individuals, it is a little bit harder to make the argument that the entity that would be deriving something like rent or lease payments, sort of typical passive income, is actually carrying on a business. And so that will be a stumbling block for some clients who want to access temporary full expensing. But good news for some, it does mean that the temporary full expensing rules could potentially apply to assets that are subject to a depreciating asset lease, but there are still some things to be checked. Aside from that issue, the ATO does clarify some of the other common practical issues that come up in the temporary full expensing rules, but just bear in mind that this is a draft ruling at this stage. When the final ruling is released, we'll just make sure that any significant departures from that draft are noted. But for the time being, that is probably one of your key reference points, in addition to general ATO website material, as you're working your way through those temporary full expensing rules.
And if you want to be sure you're across the new rules, you can join Michael for the temporary full expensing webinar on Thursday, 22nd of July. Now across to Matthew on those DIV 7A loans.
Now, what's new on the DIV 7A front is that the ATO has issued some COVID-specific administrative guidance on making the 2021 annual loan repayments on your complying DIV 7A loans. Now, this guidance was quite similar to that released last year, so hopefully some of you will be familiar with the concepts. As you're probably aware, if you have a private company that makes a loan to a shareholder or related party, there's a couple of ways to deal with this in order to avoid what's probably an unwanted Division 7A deemed dividend. One of those ways is for the parties to enter into what's referred to as a complying loan agreement. Now, if this is done properly and on time, this essentially stops the loan balance from being treated as a deemed dividend under Div 7A. What you would still need to do, though, is ensure that the borrower continues to make its annual minimum loan repayments each year in order to avoid the shortfall on the loan repayments from being treated as a deemed dividend. Now, this annual repayment needs to be made by the end of the year, so by 30 June. For many clients, this might have been a difficult year to make those loan repayments. They might simply not have the cash on hand because they've been adversely impacted due to the COVID-19 situation. The good news is that there's an inbuilt mechanism in the Div 7A rules that essentially allows the client to ask the Commissioner to grant an extension on making their minimum annual loan repayments, whilst not triggering a Division 7A deemed dividend, if the client's inability to repay was due to circumstances that were essentially outside their control. Now, the ATO in that regard has issued some very COVID-specific administrative guidance, which essentially says if your client was unable to pay due to the adverse implications caused by the COVID-19 situation, then there is now a streamlined specific process that you can go through to apply to the ATO to grant relief. The way it works is if the ATO does grant that relief, the borrower's minimum repayments that it would have otherwise had to make by the 30th of June 2021 is essentially deferred until the end of the 2022 income year, basically giving them a 12-month extension. So by 30th of June 2022, the client would have essentially been required to make up its annual repayments for both the 2021 and the 2022 income year. Now, applying for relief from the Commissioner is optional, it's not mandatory, but there's just some potential good relief there if you've got clients that are simply unable to pay or make their loan repayments and they've been impacted due to COVID-19 or due to the COVID-19 situation. Now, it's really on us to identify those clients and just maybe check whether it's appropriate for them to apply for relief. And if so, just making sure that they've got the evidence and appropriate substantiation on hand, just to back up the fact that they meet the conditions.
Now we're going to jump across to legislation. Parliament has passed the bill increasing the number of members you can have in a self-managed super fund from 4 to 6. The bill was passed and then received royal assent on 22nd of June. This means that the date of effect is 1 July 2021. So you can have 6-member self-managed super funds from 1 July. The question is, why did the rules change? Particularly when 70% of self-managed super funds have just 2 members and only 4% have 4 members. And the Senate debate on this one got quite fiery, with Senator McAllister stating that the people who will benefit most from these arrangements are financial advisors giving shonky advice. Ouch, Senator. Let's cross to Natalie Scott, Knowledge Shop Superwoman, to answer the question of why you would want 6-member funds and some of the practical issues that come out of that configuration. Across to you, Natalie.
The government's intention around this bill was to increase flexibility and choice for SMSF members, particularly those that have large family groups. Allowing 6 members could become useful for estate planning purposes. One example that springs to mind is a family business that holds the business premises in the SMSF. Adding another 2 members to this fund could help pay out any death benefits once the mum or dad passes away. The added funds could allow the business premises to remain in the SMSF environment. On the flip side, the more members involved in an SMSF, the higher the chance of a dispute or conflicts of interest. It is important that advisors ensure their clients are aware of these potential issues before entering into an SMSF. Finally, on the administration side, currently, if an SMSF has more than 1 director member, the financials must be signed by at least 2 members in their capacity as individual trustee or as a director of the corporate trustee. As there cannot be more than 4 members of an SMSF under the current rules, these requirements ensure that all members sign the financials of the SMSF. Under the updated requirements, an SMSF with 1 or 2 members or individual trustees must have its accounts and financials signed by all those directors or trustees. For all other SMSFs, by that I mean SMSFs with members between 3 and 6 members, the financials of the SMSF must be signed by at least half of the directors or the individual trustees.
And finally, across to Michael on that case, the accountant and the cash flow boost integrity rules.
Well, in the last month, we've seen a case run through the AAT dealing with the integrity rules contained within the cash flow boost provisions. Basically, what happened here was the taxpayer was operating business through a company. This was actually an accounting practice, and the taxpayer running the business through a company had been paying themselves some directors' fees of a relatively small amount, just a little bit over $1,000 a quarter for a number of years. And indeed, the similar types of payments were made in the first 2 quarters of the 2020 income year. So for the September and December 2019 quarters, those similar relatively small amounts were paid to the individual. Now, because of the amounts involved, there was no PAYG withholding obligation because we're dealing with amounts that were under the tax-free threshold. Now, shortly after the government released details of the cash flow boost scheme, the company paid some salary or wages to the individual of around $100,000 as a single lump sum amount. And that was reported and basically generated a PAYG withholding obligation of just over $50,000. And for those of you who know the cash flow boost rules pretty well, you'll know that that would have given this company the maximum entitlement to the cash flow boost. Now, the ATO picked up on this kind of significant one-off amount declared as salary and wages in that quarter, and obviously selected this as an item or a case that should be reviewed in light of the cash flow boost integrity rules. And the cash flow boost integrity rules are basically there to stop people undertaking arrangements in a contrived or artificial way to access the cash flow boost or to increase entitlements under the cash flow boost. So really the dispute was around those integrity rules. Now, this matter ended up before the tribunal, and ultimately the AAT found that the commissioner's approach to this was correct and that the integrity rules should be used to disallow access to the cash flow boost in this scenario. Now, one of the things that worked against the taxpayer in this case was the fact that they were a tax agent and an accountant, basically. And the AAT noted that they should have known that paying this one-off very significant lump sum amount in one go rather than spreading it out over a period of time would have generated this significant PAYG withholding liability, which would then have, of course, generated the cash flow boost entitlement as well. And the fact that we were dealing with someone who was an accountant and familiar with the tax system, actually worked against them in this case. The taxpayer, one of the arguments that the taxpayer raised in this case was that they were in the process of trying to have some loans refinanced. And that they'd been in discussions with lenders, and that lenders would look on salary and wages in a more favourable light compared to payment of dividends out of the company. And so the taxpayer said, well, the reason that I made this very large one-off payment of salary or wages wasn't to do with the cash flow boost. It was actually more to basically improve my chances of being able to obtain a new loan or on favourable rates. Now, the AAT wasn't convinced by that argument and found that even if there was something to that argument, it wasn't enough to overcome the application of the integrity provisions. So we can see here as far as I'm aware anyway, the first example of these integrity rules within the cash flow boost rules really being tested properly. Now, this is just the tribunal, and I kind of say that with all respect. This isn't the federal court, it's not the high court, but it is an independent body coming and having a look at a scenario which the ATO thought was a bit of an issue under the integrity rules. And just something to keep in mind, I mean, as the cash flow boost scheme played its way out, particularly in the early days, lots of people were being asked by their clients whether it would be appropriate or okay to basically pay themselves salary and wages now, when in the past they had tended to take money out of those entities as dividends or trust distributions. So we will possibly see a few more of these as the ATO starts to review cash flow boost claims in a little bit more detail. The other thing to be aware of is that JobKeeper is also a set of provisions that have some integrity rules built into them, and we're still early days. It's quite possible that we'll see the ATO picking up on JobKeeper claims as well, in light of not only technical requirements under the rules, but also the integrity or anti-avoidance provisions within the JobKeeper system. So we'll keep our eyes peeled for that. I wouldn't be surprised if we do see a few more of these cash flow boost type issues come up, some JobKeeper related issues come up as well, where the ATO is seeking to not so much pick on technical aspects of the rules, more so looking at the way an arrangement seems to appear in terms of integrity rules and whether steps have been taken on in an unusual way, in a sense, that depart from recent history anyway for those entities that might cause some concern. So ultimately, taxpayer failed in this case. The ATO was successful. We'll wait and see whether this ends up being appealed further. If it was, it would make probably a pretty interesting case. We'll wait and see, and we'll certainly let you know if we see any further developments in this area.
And that's the tax roundup for this month. We might be in lockdown, but we're working hard to keep advisors on top of change. If you'd like to see what Knowledge Shop can do for your company, your firm, we'd love to show you what we do, and we can do it all online. Give the team a call and go in through the website at the moment on www.knowledgeshop.com.au, and we'd love to show you what we do. See you next month.